Hey everybody, this is Brent from Wolf on Wall Street Trade, and I got a market update. Last weekend's was like 35 minutes. I'm going to keep this one a lot shorter. But last weekend I really pointed out that we did have this key reversal day in the S&P 500, and this past week over here, S&P down about 2.25%, NASDAQ 100 down 3%. So the worst week for the market since March. So right the week after we get this key reversal day, S&P does nothing in here, like a 3-day range of 0.6%, nothing. And then we get this really bad breakdown. But there's really two concepts I really want to touch on in this video. One is patience. I've been doing this almost 25 years, full-time trading, everything. And I've probably lost more money or made more bad trades just out of not having enough patience, like thinking things should happen in the market faster than they do happen. And we have a rally that is almost, it's going on 10 months old. So a lot of times these reversals from a rally like this are proportional to the preceding trend. So if you have a preceding trend, a rally that's 9 or 10 months old, it's very, very rare that it's just going to like reverse in a week. Unless you get something like, we had the COVID crash. You see major deflationary events. But a lot of times, most of the time, I think almost all the time that I've called a crash, I've seen it coming a couple weeks or a month in advance through other assets, how they're acting. And that dovetails into my second thing I want to share is this realization that changes in trend are almost always preceded by changes in character. And changes in character can be very subtle at times. I watch the market all day, so I see these things. But, in June, we were starting to see selling of the mega caps, these stocks that had basically carried the entire market, the entire rally for all of 2023, NASDAQ especially, over 40%. So we were seeing that change in character in June. That didn't necessarily mean that we were going to have a change in trend, but that was the first start. And then, like last week, we had this key reversal day in the S&P 500. So they just build up. And with those things, as they build up, your probabilities build up. And that's really what you have to go on in an investment or a trade. Nothing is guaranteed, so you go with the highest probability and good risk management. So I think those two concepts actually complement each other. Looking for changes in character, because those are going to precede changes in trends, and being patient enough to wait for those. And just realizing that it's going to be proportional to the preceding trend. So the same reason that we had a really nasty key reversal day last week is the same reason that we had a pretty bad week, worst week since March in the averages, and that's really yields. Yields are climbing, they're really high. In the US, we had our AAA credit rating downgraded to AA by Fitch. That actually didn't send yields higher, believe it or not. But yields were sharply higher Wednesday, so we were downgraded Tuesday night. Okay, so we're looking at a 10-minute chart of the S&P 500, and I've backed it up to Wednesday. So again, the same reason that the mega caps were destroyed in 2022 in the bear market, higher yields, was what we saw this week. So here's the downgrade, and then here's Wednesday morning, prices gapping down. So I've just rolled back this chart till Wednesday, towards the end of the day. We did have like a little intraday bear flag Wednesday, and that would have given us a measured move of 44.50 to the downside, but I kept saying, I think this 4,500 level is going to hold as support tomorrow, and then we'll see where we go from there. So if we roll forward into Thursday, there's Thursday morning, we test down to it, and we do hold 4,500 because it's just a psychological level. It's an important level for traders. And if you look back at last weekend's video, I show you why 4,600 and 4,500 are really important going back to late 2021. And a big part of the reason that I thought 4,500 would hold here was because Thursday we had Amazon and Apple earnings, which are basically the key earnings of earnings season. We also had payrolls Friday morning, so we wouldn't know any of that stuff until after the close Thursday. So we held up here at 4,500, didn't make this measured move to 4,450. But it wasn't pretty. So even at holding support at 4,500, like Thursday night, I think in the daily wrap, I showed subscribers that 3C was actually leading lower. Like we were seeing selling, even though price was holding at 4,500. Hopefully you can see this. This is that Thursday daily wrap, and I'm just showing charts of the SPY over here, and you can see 3C leading lower, even though SP was holding 4,500, and QQQ, towards the end of the day, 3C is leading lower. So holding 4,500, but not looking great. And let me just roll forward through the rest of the week, and we come into Friday and just boom, bang. I want to show you a different perspective, though, I'll show you the small bear flag that we saw on Wednesday intraday, but I want to show you a different perspective of this chart. And here's the perspective. So coming in to this 4,600 level, we have a bullish ascending triangle. And I always say to subscribers, the early breakout part of a breakout from a bullish triangle, or even a breakdown from like a bear flag, like over here, is one of the most dangerous parts. So it ran right into 4,600, this level that I was talking about last weekend in the video. That's so important to 2021 and still now. That's the key reversal day. Here's 3 days of doing nothing in like a 0.6% range between all 3 days. And then here's our breakdown, right? This is a bear flag right at 4,500, and then you can see it just break down Friday afternoon. So just two different perspectives of the same price action, but this bear flag actually tells us that we have a little bit more downside to go early next week probably. So putting these things together, we have a failed bullish consolidation, we have a failed breakout, we have a key reversal day at a really important level over here, 4,600. We also now have a breakaway gap to the downside, and that breakaway gap was right through 45.50 over here. So a lot of things are now starting to turn a lot more negative in terms of the character of the market. Here's QQQ on a 30-minute chart. I think I talked about this last weekend too, that what was happening over here was just too volatile, in my opinion, for like a bullish consolidation, a bull flag. And this is another important level that I talked about last weekend, going back to 2021, 15,500. And look at this breakaway gap right through it, and a bear flag on Friday. Or rather, I should say a bear flag breaking down on Friday over here. So again, all this stuff was covered last weekend, and I'm just kind of following up now. But what this is all really coming back to is bond yields. And I could talk on that for probably like an hour, but a lot of things happened this week. So we had the Bank of Japan doing a policy tweak of the yield curve control that freaked out the market last week and caused that key reversal day. Some more similar stuff this week with that. Fitch's downgrade of the U.S. credit rating. And we're starting to see a bump in inflation again. So gas prices, a lot of food stocks are seeing bumps in inflation. Now, inflation, in my opinion, has peaked and we're on the downside of it. But a trend is never just a straight line. There's bumps and there's noise in it. So in January, we had inflationary trends. And in February, we got all of that data. And that really caused the market just to pull back all of February. Okay, so now we're looking at the 10-year yield. And what I want to point out is this is October. So this is where all the bases started for the rallies that we're in stocks right now that have gone on ever since October. So this is what I was calling at the time peak inflation and peak Fed hawkishness. That didn't mean that they were going to pivot. It meant we were at the peak of it and we were going to start coming down the downside. So for instance, the Fed went from hiking 75 basis points every meeting down to 50, then down to 25, then they're skipping one. So peak Fed hawkishness, peak inflation. But if you look at what has happened with yields, I mean, this week, the 10 and 30-year bond yields have come back up to levels that were seen pretty much last November. And to put that in context for you, if we look at where the S&P-500 was last November or thereabouts, it was some 20% lower. The NASDAQ 100 was, I think, 43% lower. So the last time bond yields were here, where we are now, we had much lower valuations. So that is what you're seeing right now as the actual catalyst that has been driving recent trade. But I do think that we're getting into an area here where we're going to see some toppy formations, and we're going to see that process play out, and that's going to move into a reversal of some sort. What it is, how deep it is, we won't know that till we see the toppy process and can get measured moves from it. But my whole thing has been that in the second half of the year that we're going to see the Fed's tightening because of the lagged effect of monetary policy. We're going to see the tightening really ramp up in the economy the second half of this year. And if we look at data, I mean, it's coming in that way. If we look at how Apple reported, here's a 60-minute chart of Apple. breaking this massive, massive uptrend. A lot of people say, as Apple goes, so goes the market. But this massive uptrend has been stellar, and reported earnings broke down. So Apple's had 3 consecutive quarters of declining sales. And remember what I said about us seeing institutional money selling, starting to take profits back here in mid-June. I'll show you Apple real quick because that was one of the stocks we saw it in. We can see in May that 3C is leading price higher. This is Apple's price. And then as we come into June, like mid-June here, 3C is like negatively diverging. It's making lower highs, lower lows, while price is still moving up. So that was one of the early changes in character that we're seeing in mega caps everywhere, tech, NASDAQ. But notice that was mid-June, so it took some time for Apple to break that trend. But that's another change in character, is Apple breaking this massive uptrend. And here's Apple on a daily chart. So isn't it funny too that the time it breaks that massive uptrend, it's also breaking its 50-day moving average and on huge, huge volume. So a lot of things happening, and they are just the latest developments in these changes in character that we've been seeing pretty much since like mid-June. Amazon did beat, and they had a great day on Friday, but look at this candlestick. It's like a shooting star. That's not a great candlestick for a big, earnings celebration day on big volume. Okay, now I'm just going to run you through some sectors real quick. The 3 mega cap heavy sectors are consumer discretionary, which I have up here. So Amazon and Tesla are the biggest components in that sector. So we got a trend line again, like we saw in Apple, with a breakdown, a bear flag. This bear flag broke down. The only reason price came back up was Amazon's earnings on Thursday night. So we saw that gap up on Friday, but change in character there. Here's the communication sector. So the big mega caps in there are former Facebook, Meta, and Alphabet, Google. And you can see prices starting to break down around that. The only reason that price was saved over here was because of Meta and Alphabet's earnings that came in well. But now price is back below this trend line. And then the most important, most heavily weighted sector is technology. And we can see, just like Apple, it's breaking down from this uptrend. Semiconductors are a great leading indicator for the tech sector. So here is the Philly Semiconductor Index. And you can see, price found this resistance over here, could not get back above it, and now it's kind of just hanging out right under this trend line. I wouldn't call that a really bad break yet, but this was definitely one of the ones I've been watching, especially as a leading indicator for the tech sector. So the fact that it couldn't make a new high over here was bothersome, and then this breakdown, and it looks like almost a small bear flag forming over here. Here is the mega cap index, or what I use for it. I try to stay consistent, so I use MGK all the time. It's had this massive uptrend, just like those 3 sectors, and it's breaking down this week too. This is the stuff we were seeing, again, in June, that money was quietly coming out while everybody was getting this FOMO trade and the AI narrative. Smart money was quietly selling their shares to them. That's what 3C was showing in mid-June. This is the industrial sector, and this is like something completely different. These are pro-cyclical sectors. Of them, one of them is acting pretty well. That's energy. But we do see the industrial sector breaking down over here, and I think also the financial sector too. Yeah, it's not a horrible break like we're seeing like in Apple or in tech, where it's a little bit more vertical. But the trend is changing. This is not as long of a trend either as those other ones. So like the mega cap or Apple, I think Apple, it was all of 2023. Apple, that's a 2-hour chart. So that trend goes back to at least March, and it was in an uptrend from January, but this particular trend line goes back to March. So I think we can kind of use Apple as an example of potentially 2 scenarios that could happen. We could get the kind of back test. So usually when you have a really strong trend like this that's acted as support and it breaks, you'll often get a back test. So a rally back up into it, and it will usually find resistance there. So we could get the back test and filling gaps. And it would be especially important for like the NASDAQ and the S&P-500 if those breakaway gaps remain open, which would be very bearish, or whether or not they're filled. I do think we have a little bit more downside in the first part of the week just because of the measured move on the bear flags. So here's the S&P 500, like a real quick measured move, about 2%. So I think it's like probably hit about half of that since it's broke down from this bear flag. But in any case, I think we have a little bit more room to run. This is that breakaway gap in the S&P 500. And here it is in the NASDAQ, right at 1550, this really important level that I keep talking about from 2021. So whether or not these get filled is going to be really important moving forward as to what kind of market we're going to be dealing with. The other scenario that we could be dealing with is CTAs, so commodity trading advisors, which are basically trend following systems. And when they hit certain levels, they will automatically deleverage. Or if volatility goes up, like we saw this week with VIX, they will automatically deleverage, which means they'll sell. So those levels are always estimated. There's a few firms that are really good at it. Goldman Sachs is pretty good at it. Charlie McElligott from Nomura. A lot of us don't have access to that kind of stuff. And these are estimated levels. But if you see really heavy selling, it's usually the CTAs are hitting like trigger levels where they have to deleverage. So we could see that. But my call would be that because we have, almost a 10-month uptrend, that we will see a toppy formation forming. And I think this is just, we're seeing the start of it with the key reversal day, with the breakaway gap, the bear flag and prices just dropping right through 4,500. This is what the 3C charts have been forecasting to us, not in the sense of like a crash or anything like that, but in the sense of that strong support, that strong institutional support of the mega caps, especially that we saw all of 2023 was coming out in June. We're seeing a lot more weakness in these stocks because they don't have the same level of institutional support anymore. As far as the macro perspective, like I said, phase two, I have three phases that I believe we're going through. I think phase one was this, the rally. Phase two is the economy starting to turn because of the lagged effect of monetary policy starting to catch up to the economy. So we're starting to see that, like I said, Apple, 3 quarters of declining sales. We got the really important key payrolls report on Friday, which the Fed is going to be watching like a hawk. Now, the payrolls report, I don't think it's had like any disappointments in almost 2 years. I think it's had like 14 consecutive beats, but the last 2 reports both missed. So the July report was 187K. And if it hadn't been for June being revised down to 185K, that would have been the worst payrolls print since December 2020. So we're starting to see the macro data or the economic data kind of change with the macro situation, as well as these things we're seeing in the stock market. Another one I remember from this week was the JOLTS job openings, right? The job openings report, which has been stellar for like 2 years. This week, it had the fewest job openings in over 2 years. So going back to April of 2021. And manufacturing in the U.S. has been in a recession, right? But services has been very strong. And now we're starting to see cracks in services. But I do think what's important is that all of those rate hikes since March of 2022, 525 to 550 basis points from zero, are going to start hitting the economy stronger and stronger in the coming months. And we are going to see a recession. We're going to see a recession in corporate profits, and stocks are going to be marked down. I do think that we probably will end up back in a bear market. I don't know this year, maybe this year, but I think we're really going to see that happening in the second half of this year, which just started in July. So thanks for listening. Hopefully this wasn't too long, and enjoy the rest of your weekend. Members, I'll see you on Monday.